Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today, talking about some very exciting slash nerve-wracking news that have been hitting the capital markets recently. We're talking geopolitical risk. Today, we're talking specifically about Ecopetrol, Energía para el Futuro. It is a Colombian mega cap fully integrated producer and refiner. So we're going to talk about that today and why I have positioned it as a very for an emerging market, a very heavy weighting in the portfolio. If you're new to the channel, please do like and subscribe. Got some great content coming out for you guys. Hope you really enjoy it. And if you are not aware, I am a popular investor on eToro, so you can add me to a watch list and take a look at the basic portfolio that I run there. And I'm also in charge of an options investment portfolio that's private and outside the scope of our discussion today. Having said that, without further ado, let's go through my analyses. Very basic today, guys. It'll be very quick. Ecopetrol. Disclaimer, I'm not a financial advisor. I'm not trying to advise you or advising you. Anything you hear me say on the channel is just my opinion, okay? This is just what I'm doing with my money and the money that I'm in charge of. I just I'm telling you what I think of what I'm doing. Not advice, not a solicitation. What I do may not be right, and it may not be right for you. My risk profile is almost certainly not the same as yours. Okay, I have a very high risk profile, so please do understand that, guys. Take this stuff seriously and make sure you take responsibility for your investment decisions and any associated consequences. Having said that, for those of you who may be interested in my private publication on Substack, you can join the ROI Club. It is a monthly subscription where I put out a ton of content around macro environment and specific stock analyses. I do one in-depth article every month where I talk about the month in review, month ahead, geopolitically and macroeconomically for capital markets. And I always do a deep dive into my pick in terms of an investment analysis. So you can get that. And as well today, if you click in the link that I'll leave in the description, I'm going to show you an options play that I'm in, two options plays actually, that I'm using with regards to Ecopetrol to max out a potential five bagger in terms of an ROI, which I think is highly likely, and how I am gaining huge KGARs on an income play using this as a particular underlying stock. So I hope you like that, guys. You also get access to a spreadsheet that I keep with stocks that I follow, and that updates automatically, so you can take a look at my valuations. It's not very expensive at all. If you pay annually, it's $5 a month. That's it. Okay, without further ado, let's get into it. So whenever you see a chart like this, okay, this is a yearly chart, okay? So when you see something down 50% on the year, you start to ask some questions. So my attention is obviously peaked when I see something like this. And obviously we've got a lot more homework to do, but if we get a huge sell-off, we need to ask ourselves why that happened. Is that a result of fundamentals and facts, or is it purely a narrative-driven sell-off? So very interesting. We're going to talk about Ecopetrol today. Here we go. I am looking here at some balance sheets, one pager. Okay, so very easy, quick and dirty way of looking at it. Some balance sheet considerations. We have the market cap, shares outstanding, net debt, price to book. This is looking in the rearview mirror. Okay, so the last 12 months for all of these. And so the price to book at the moment is about 1. So you're paying about 1 times the book value for this company. And let's look, a few things to point out here. These are more of the income and profit generation. If we take a look at EV to EBITDA for the next 3 months expected, you're paying it roughly 3 times expected EBITDA. And I don't agree with that because I think it's way too low. I don't think, looking at the analysts out there and their estimates for EBITDA and free cash flow for this year, as in 2022, I don't know what they're using, but it's very low. It's nowhere near. It's about half what I expect Ecopetrol to produce. So if we look at the LTM for the last 12 months, it's less than 3. I think it's about 2.5 to maybe 3, depending on what happens at this end of the quarter. If the company is able to produce about 8 bill in free cash flow, and then it'll be about 7 billion, depending on the sliding tax scale, which we're about to talk about. Obviously, that would be, you call it 8 billion on a market cap of 20 billion. we're a bit over 2 times the free cash flow for a humongous, one of the key producers in the world with refining capacity. So very important. What I pointed out here is CapEx to cash flows from operation. So 47% of the cash that they earn from operations is being reinvested into production. Now, that's not the case in many parts in the, let's say, developed world. And to give you an idea here, I've put in Cenovus's numbers using the same Coifin numbers. Cenovus is another holding that we have. We've been holding that for a lot longer. Canadian domiciled company. It's comparable because it is a fully integrated producer and refiner as well. So only 30% of their cash is being reinvested into CapEx, because in North America at the moment, we've got this theme that I've been talking about for over 2 years, nearly 3 years now, where those producers are not being incentivized to invest more into production, okay? They're giving that cash back to us as the shareholders, which we really like, and is, I guess, further contributing to the floor under the oil price. So why I like Ecopetrol is that they are willing to produce, and more than half their wells are outside of Colombia. So that's an interesting fact that I think a lot of people are missing. Let's take a look at the yield. So if we come down here, free cash flow to the market cap, okay, so the price you're paying today, how much are you getting back as free cash flow? 20%. So obviously that's, historically pretty damn good. High inflationary environment, pretty good. Whereas at the moment, Cenovus is at 13% as a yield, which is not bad at all, considering the company size that it is. But of course, what you're paying there for a premium, because Canada is considered a safer jurisdiction. Arguments can be made for and against that. Let's take a look. I got a one-pager here for you guys with regards to Ecopetrol. Revenues, this gives you an indication of the company. So 31.6 billion expected in revenue for 2022. EBITDA, I don't know what the analysts are thinking here. So EBITDA, this is what they've been put in. But if you go through and you look at the company's quarterly presentation and you're looking at the cash flows, they're producing almost 2 billion per quarter. Okay, 3 billion in the first quarter. We had the spike in oil prices. Then it was a little bit lower in Q2. Q2 and Q3. So I've extrapolated at 2 billion over an annualized figure to kind of smooth it out. We might hit 8 billion in free cash flow. Okay, so on an EV at the moment of 45 billion, that's market cap plus net cash or net debt in this case. You're getting an 18% yield. If we look at the market cap, you're getting nearly a 40% free cash flow yield. Okay. The historic mean, in this case, we can't really use it. If you regress and use the software, it comes up at well over 20x, and I'm just not comfortable using that as free cash flow yield. So what I would look at this logically, and this is where you got to take a step back sometimes from the numbers and say, well, what if this company traded at a 10% cash flow yield? Okay, so if we were getting 80 billion, so 8 billion a year times 10, if the market were willing to pay that, we'd be looking at nearly a double on the upside in terms of the enterprise value. Okay, so that's more of, I think, it's more of a rough metric, but I think it's going to be far more accurate in the long term. I don't think you want to be delving around with historic mean and multiples and things like that for this. I think we want to look at it logically, based on the fact that it's an emerging market, based on the fact that of where we are in terms of the energy crisis, but with the political pressures that have caused that, have also reduced capital flows. So something to bear in mind. Price is trading at last close $9.95 US, tangible book value around about the same. So you're paying for the book value of this asset. I mean, something's got to be very, very wrong for us not to be interested then. We've got to really take a look and say, well, hang on a minute. Are things really that bad? Return on equity, 35% over the last 12 months. So obviously something's got to be going on. What is it? What are the warts? What's the ugly stuff with this company? So this year, Colombia saw fit to elect Gustavo Pedro. He's commie, basically. Okay, if you watch Narcos and you see the guys out in the jungle, M19 and Farc and all those guys, the Marxists, he's basically one of them. Anyway, he ends up in politics. So He gets in the way that all socialists really get in, selling free stuff and utopia. And of course, topically today, hydrocarbons are unfashionable. So he's promised to end the hydrocarbon business for Colombia and turn it into like a tourist destination. That's how apparently he's going to fund the entire country. Obviously, that's not going to work. And those constraints are being realized. Also, another thing to bear in mind are the differences between what someone can do and what they say they're going to do based on government regulations and the constraints. So down here, I've put in a key title for you guys. For the people who are asking me about the books, on one of my bookshelves here is this book, Geopolitical Alpha by Marco Papic. Very, very good book. And one thing, obviously it's his specialty, one thing that has really taught me is to ignore the rhetoric and to look at the constraints. Okay, so to look at the laws and the situation in certain countries to figure out what actually can happen and be passed through Parliament and any given nation's Congress versus what the president or the prime minister says they're going to do. Okay, so unless it's a pure dictatorship, you want to look at the constraints. And so in this case, I think his bark is bigger than his bite. He's got 4 years, and I don't think he's going to be able to do a Maduro on us, let's say, because they've already been attempts at that were thwarted 10 years ago. So the ability for someone to come in and have laws change to allow them to stay in power forever and ever, much harder to do that in Colombia than what we've seen in China or Venezuela, for example. So what spooked the market, and we saw that 50% sell-off, is the idea that because the Colombian government effectively owns 80% of this company, that they are going to increase the taxes through the roof. And so people got very, very scared about that. A similar situation has happened in Brazil with the election of Lula, and then that's going to be my next video. What you've got to look at is you've got a sliding scale on taxes here that will increase for sure, but it's done on Brent price and on a 10-year average. So let me explain. So the worst case, if I really narrow it down, the worst case, you'll have a tax increase of 15%, which will take it from roughly, call it 33 up to, I know it's more than 15 to say it's to 50, but it could get to 50 depending on the Brent prices. However, the 10-year Brent price is what's being used. And so that at the moment is around about $70, I believe. And so if you work it out, to get into that highest bracket, you would need that 10-year average to rise above $82 a barrel for Brent. And that could well happen. I believe we'll see some sort of an oil squeeze. But remember, 10 years ago, we're including the 2014 drop-off after that whole extravagant capex, let's call it, the situation. And then we had COVID, of course, where the futures went negative. So that forms part of the base effect, okay, for the average price. So it'll take a lot to get to that level. And by that time, this company will have made a hell of a lot of profit, okay? So it's worth just keeping a cool head and taking a step back and analyzing things in a rational manner. Another thing people are worried about is there is a government order that there'll be no further fracking in Colombia. So you've got 207 government contracts that will be honored. So there's no new ones being put out. But my understanding is that those 207 will be honored, and about 50% of those are still to be put into production. So there's still scope for Ecopetrol to increase their Colombian, or to maintain at the very least their Colombian production. And yeah, ignore the rhetoric, focus on the constraints, have a good read of Marco Papic's Geopolitical Alpha. And I think you're going to get a lot out of it. So talking about the practicalities and delving into those constraints a little more. The practicalities, what are they? So the stock is sold off 50%, but if you work out what the estimated impacts to the earnings are, that's going to be about 8%. So obviously, clearly there's a disconnect there. Let's remember, barring a real left tail event where somehow the left takes over and they're in Colombia and they're able to rewrite the laws and effectively write themselves into a dictatorship. In Colombia, I think that would be very difficult, especially given what's happened in Venezuela. I think you'd be I'm not going to say there's zero chance, but I think it'd be highly unlikely. With the center-right alliances in Colombia and the attempts to repeal some of the term limits in 2010 being rejected, I think that that's a very unlikely scenario to happen. And so I think the market has overreacted to that. So I'm willing to speculate on this company. In addition to the fact that if that is true and correct, what we believe, well, then we would expect, given how weak Petro's victory really was, he didn't get the majority in the first instance, and so they had to go to a runoff, and then he did end up getting in. He doesn't seem to have a lot of political power, as much as he would like, at least, to be able to implement some of the things that he wants to do. And so I think he's probably, not definitely, probably going to be a one-term president, in which case a hell of a lot of these executive order type rulings will be revoked and the stock will fly. Or if he does get in for a second term and we have a status quo that rolls over for another 4 years, the pricing of this company, it doesn't make any sense from its terminal value. So if you're paying about really 2.5 to maybe 3 times the expected cash flows, that's the market essentially telling you that it thinks that this company will be worthless by the time Petro leaves office. And that doesn't seem to be the case. Remember, we've got 53% of its exporting projects are actually based in the US. They're not even in Colombia. Export and refining capacity is a huge advantage at the moment, given the bottlenecks in diesel and refined fuel products. See my interview with Shubham Garg from White Tundra Investments on the ROI podcast. He goes in depth in here, and one of the questions that I asked him is, where are you looking and why are you looking in terms of geopolitical places to invest? Where do you think is going to have a lot of advantage? His answer was whoever or wherever is investing in refining capacity. I think that's a very important point. And that's what Ecopetrol has. So if we said, look, we can get an estimate of, depending on the Brent price, $500 million to $1 billion extra in tax on that sort of $8 billion in free cash profit, then you're paying $20 billion for $7 to $8 billion in profits. And so essentially that's the arithmetic proof that the market thinks this business, or it's pricing in that this business is going to be dead by the time Petro leaves office if he's a one-termer. It just doesn't make any sense from that perspective. Okay. Further considerations that might change your mind about this company. In the purple here, you have crude futures prices. Okay. That's what this company sells essentially. Yes, they got gas, but if we put it to a BOE, a barrel of oil equivalent, we're interested in the oil price for this company. Well, I am anyway. Here's the price of the stock. Okay. So if we go back to April 20, it was in 2020, the price of oil futures was $17.50. Remember those days? Good times. And I don't think we're going back there anytime soon at all, guys. Just my personal opinion. And the share price was effectively exactly where it is today. So again, you got to step back and look at this and say, people are so scared of this guerrilla that they think things are as bad for this oil company as in the midst of the COVID crisis, where oil was trading at record low prices. And so I don't think that is an accurate disconnect. Okay, look at the price action of what this company is selling. It's selling oil. The price of oil has gone through the roof, and the price of the ability to buy the company has gone nowhere. Obviously, a disconnect there. Obviously. So if we take a look at the yearly chart, purely from a price action perspective, here you can see we've had a huge retracement. Here you've got, this is a relative chart, the price of the stock priced in oil. So how many units of crude oil would it take as a ratio to buy a share of the company? And as you can see, we're at almost record lows, almost. Okay. So I think that we can get maybe a 50% upside to 63% if you look at the top of the ratios here really quite quickly. I think it might be likely be less than 12 months given the way that we're going. Okay, so That's it, guys. I don't want to make this complicated. This is not a typical play for me. I think this is more of a tactical play that the market has just thrown out this company. They will give out a hell of a lot in terms of dividends. And so I'm looking to go long to 3 to maybe 5% of AUM for reasons that I'll mention. I want to diversify a little bit outside of North America, where most of our holdings are and where they always will be. I think this is an opportunity to provide alpha and alpha to the sector. I think that the refining capacity is a huge advantage for this company that people are just giving it no credit. And the narrative is far worse than the reality. Cash flow will be cyclical. And I see this very much as I do Petrobras. I see this as a reversion play in a short to medium term hold. So I'm not going to extrapolate out and do DCFs or IRR calculations for a decade. I personally don't intend to hold this company for that amount of time. I think that I want to be in the oil. I want to be in the energy sector. I particularly want to be in hydrocarbons, and I want to be in emerging markets with refining capacity. This company's trading at 50% of what I could buy it for. It's trading basically on the relative basis of where it was in the midst of the COVID crisis. This to me is screaming a reversion play, and so I am willing to speculate. The risks are not zero, obviously, but this is what I'm doing. I'm putting it into the eToro portfolio, and I'm also trading equity and equity options in a private fund. So hopefully you enjoyed that, guys. Again, a quick plug for the ROI Club. If you're interested, take a look at some of the content that I have in there. There are lots of different equity valuations, so you can see some of my favorite stocks that you can't see on eToro. I go through and I give the valuations. I show you some of the big plays that I'm expected, or that I am making, and that I expect to make me a lot of money over the next 12 to 18 months. People have done very well, those starting members, and there's a free trial, so you can try a free try a subscription. If you don't like it within 7 days, you don't have to pay anything. Okay, so very, very no risk, low risk. And if you're into your options, I think you're going to get a hell of a lot out of it. Really going to up the ante in terms of the options content moving forwards. Thank you very much for watching. If you are looking to copy the moves that I make, you can copy the portfolio on eToro if you have some spare change. Minimum investment, I believe, is $200. Or you can just add to a watch list and see how we go. I'm on Twitter. If you want to hit me up on Twitter, always keen for a chat. And please do like and subscribe to the channel. I greatly appreciate all the support and the interaction with the comments. And so that's why I love what I'm doing. All the best, guys. Take care, and I'll catch up with you shortly with another episode of either the ROI podcast or the ROI channel. Thank you.